guess the question on everyone's mind, are we in for more controlled movement when it comes to FTSE 100, or finally, are we going to see breakouts enjoy better follow through? Hello everyone, Monty here, market analyst Lanji, with another technical cheat sheet video where we take a look at key technical indicators, formulate an overview, prep strategies, whether you're in the conformist camp or you like to go contrarian, includes levels on both daily and weekly time frame, which haven't changed that much when it comes to FTSE 100, as well as where traders stand prior. Now, we don't get COT figures when it comes to FTSE 100, so we are going to take a look at US indices for that, and then we take a look at IG client sentiment and map it onto the chart when it comes to the FTSE 100, as well as fundamental considerations. It is a significant week for the US. It's also a significant week for the UK, and therefore those of you trading the FTSE, beware. So let's go ahead and get started. Price, when it comes to its main short and long-term weekly moving averages, we'll take a look at the weekly chart first. The chart's courtesy of IG's trading platform. Price is above both of them, especially after the latest gains that we saw last week. And with DMI, that if you take a look over here, I've actually plotted over here. You got negative DI over the positive DI. Not much of a margin there. Overall, you consider that to be neutral. And ADX nowhere near trending territory. RSI actually not that far off overbought territory. And price, we could say, closer to the upper end of the band, but still well within it. Now, overall, you take a look at this and you're thinking to yourself, okay, what kind of overview? I know this is the subjective part of the video in terms of classifying what the overview is, because that means from there, we're going to take it and we're going to go ahead and map what the strategies are going to be. And overall, it was cautious consolidation before. I'm talking months back when it was range bound at lower levels. It then shifted to consolidation volatile, where breakouts were expected to outperform. They did outperform. And now all of a sudden, it's a struggling bull average, where only really buying off the dips has been where traders have managed to outperform on the weekly time frame, whereas buy breakouts haven't had much follow through, with the exception of last week, just because of the moves that we saw late last week. And overall, when it comes to conformist strategies, yeah, that means if you are going with a bull average, even if it is a struggling bull average, you are looking at added caution, buying off of the dips, off of the first support level, which can be extended, by the way, to the second support as well. Even though if you do that, let's not forget, you're going to miss out on a lot of opportunities, and missing out on a lot of opportunities on the weekly time frame means you're waiting for weeks to put in a trade. And that's the reason why usually you're not working off the second levels when it comes to any market. You're usually working off the first and decided what to do there. Now, if you decide that, no, you know what, I think we're in for a hold, or it's going to go back down, you got the sell. That's what the contrarian camp is for, selling the first weekly resistance after a reversal, or selling the first support upon breakout from above. But the thing is that sell breakouts have really struggled. And I think that kind of has given the edge overall. If you look at the past several months, it's given the edge to buy strategies, and it's given the edge to the conformist camp, which is usually what you want to expect. You know, it's going to be a close call between conformist and contrarian, but you always want to take the idea that at least conformist should have the edge on average. It doesn't mean you have to follow through every single week. There are going to be weeks where contrarians do better, but it just means that at the very least, you're expecting that conformists are going to do better over the long term. Now, here's the thing. The last time we did a technical cheat sheet video on the FTSE 100, there was the idea of making a move prior to the first levels up towards it if you see it as a center of gravity. So instead of waiting until you get to the first resistance and not getting much follow through afterwards, you initiate prior and actually put the little either buy or the sell right over there. Now, this actually did very well. Back when I mentioned it, did very well at first, especially when it went up. These past couple months where it started to get a little bit range bound, that's where it struggled a little bit. And I want to say from around mid-June to mid-July, barring, of course, what we saw last week, because we finally got, had you initiated earlier with the buy breakouts, you would have done quite well. Even on the sell side, you would have gotten some follow through and much better follow through towards the upside. Now, in terms of levels, the RSP to the first resistance and the first resistance to the SL, and the same thing for the RSP to the first support and the first support to the stop loss. SL stands for stop loss, by the way. It was 103 and 51 respectively. That's what it was before. Now, not much of a change, 98 and 50. So that goes to show how relatively tame the FTSE has been, even when it goes to a new area. I mean, you have a bit of increase of volatility, and then you got that range bound movement, once again, relatively controlled and relatively tamed. It doesn't mean that reversals are going to do best. It just means that you're looking at relatively controlled movement off of these levels, and to get follow through beyond it, significant follow through, it's seen as a relative exception, unless of course you're sort of trending towards a new zone, which with the FTSE, it's more of an exception rather than the rule. At least that's what we've seen for quite some time. What about on the daily time frame? And here, of course, when I zoom into the daily time frame, you can see on the chart what I mean by that relatively range bound movement coming back towards an average. But the thing is that when you have price huddling together, when you have price going back and forth and coming back to an average for so long, you end up with key technical indicators that are going to huddle and get closer and closer to each other. Because you're coming back towards an average, well, the moving averages, they're going to move towards that as well. And that means that it's very, very easy to tilt at-risk short-term technical boxes because, look, you see this move over here. It moved up towards the upper end, and look what that's done. Price is now above all its main short and long-term moving averages. You got a DMI now in positive territory. I should say the gap between the plus DI and the negative DMI has improved. You have an ADX that's not in trending territory just yet, and RSI still beneath overbought territory, but not far off of it, and you got price at the upper end of the band. So you're looking at it going, wow, four positive technical boxes. Let's go for it. Let's go on. Hold on a second. Under normal circumstances, if you're moving up slowly and you had all these positive technical boxes, yeah, you could go for something like bull average or bull trend or stalling bull. What the overview was before and what it has been throughout this entire period of time and what it still is for now, what's going to need more in terms of distance as well as price being able to stick at these levels, if not move higher. And that means that you're sticking with a consolidation volatile overview because you're clearly suffering from price indicator proximity being easily capable of tilting box narrative. So you want to jump the gun and say, this is something bullish, go for it. On the weekly time frame, it is, but on the daily time frame, it's going to need a bit more in order to show us that in the shorter term, we're really looking at a bull trend or a bull average situation. Now, there's no denying breakouts had their day. Consolidation volatile for a while, even when it averaged back. Consolidation volatile, by the way, it's used to describe a few situations, but one of them is whenever you have intraday volatility quite high that's going past short-term levels, but it's coming back towards an average. And it's done beautifully in that regard because it did come back towards an average. And even when it did break away from the average, breakouts still did best. I mean, that's the idea. You're going for breakouts. Yeah, you're expecting an eventual coming back down, but if it doesn't, if it keeps moving higher, as was the case late last week, breakouts outperform. And in that case, they actually had quite a bit of follow through. So they actually had their day. When it comes to contrarians, you're selling the first resistance only after a significant reversal. If it presents itself, you're buying the first support only after a significant reversal. And of course, in the case of an uptick in volatility, you have a better chance of holding off the second levels in more volatile intraday sessions, like as we saw when things got a little bit volatile. And then, of course, you don't have to fade the move. If you think there's something bigger fundamental going on, you can go, for example, for a reversal. And then fading, again, is always seen as the more riskier move. You definitely don't want to fade off the first levels, though, when you're anticipating volatility. Now, breakouts, here's the thing about the breakout strategy. They did quite well, but they do struggle whenever levels widen. Now, before, the last time we did the TCS video on FTSE 100, the gap between the RSP, or relative starting point, and the first resistance and first support was 40 points. And then between the first and the stop loss was 20. Of course, the stop loss is always at your discretion, depending on what you put your take profit. But the gap, it was 40 and 20, and now we're looking at 48 and 25. So they have widened a bit, and they are a lot easier to move because you're basing it off of more short-term history compared to the weekly time frame, where you need a lot more historical data. So it incorporates a lot of calmer movements over the past. So that's when it comes to the technicals and the strategies and the levels. Of course, time to get to sentiment. Now, I'm going to start off with COT speculators. We don't have for the FTSE 100, as I mentioned. It's not available on the report, but we do have for key US equity indices. And I do want to bring this up because when it comes to the NASDAQ 100, they've shifted. Inner circle is from the previous report, outer circles for the most recent report that was released last Friday. Slight buy 52%. They've shifted to slight sell 51% in the NASDAQ 100. For the S&P 500, the majority short, 55%, shifted to the middle. So this pullback that we saw, they actually, shorts were getting out, not initiating or going with it as you would normally expect with a momentum play, like you would normally see with the Dow. What about when it comes to the Dow? They were in heavy buy 67%. They've dropped out of it to 64%. Though keep in mind that the reports released last Friday, but positioning is as of last Tuesday. So some of the momentum guys might have gotten out because the losses suffered not late last week, there were gains, but the week before that. They might have been getting out, and that's the reason why we actually saw them go opposite what we usually see, because the correlation between the Dow, the sentiment figures that we get off of the Dow, very highly correlated with momentum when it comes to its price. So usually when its price goes up or inches higher, you usually see them hold or even raise their buys. But in this case, they actually took it down, and that might have been the reason why. You have to wait until this Friday's COT report to see whether or not they actually went back in. It wouldn't surprise me if indeed they did, if the gains do manage to hold at the start of this week. What about IG client sentiment? I'm going to start with U.S. equities. U.S. Tech 100, because we had that big, it's been suffering retreat, so they're now in heavy buy territory. S&P 500, they're still heavy to the sell side, whereas when it comes to Wall Street, the Dow 30, they were heavy sell to start last week, jumping into extreme sell territory following that move that we saw late last week. Now, what about when it comes to the others? Now, the DAX and ASX, very, very, very heavy on range trading. The FTSE you'd think would have heavy range trading, usually does, but that's because it's coming back towards an average. But for the DAX, for the Germany 40 or DAX as well as the ASX, previously they were in extreme sell territory. FTSE was very close to the middle. That's because price was coming back towards an average. Let's take a look at where they are now. And when it comes to the DAX, that move that we saw, the gains that we saw last week, they're not far off extreme sell territory. ASX, by the way, holding in heavy sell territory. When it comes to FTSE, this is the one that we want. Finally, there were a slight sell, 52%, jumping. It's a major jump into heavy sell territory. Why did that happen? Well, that's what we're going to plot it onto the chart. It's the best part, right? The thing is that this is a client sentiment is the blue dotted line. We don't have a green dotted line here because no COT sentiment, but blue dotted line as percent long corresponding to the left axis. And that red line is the 50-50 line. Whenever you see the blue dot go above, the majority buy. Whenever you see it go down, majority sell. And you can see on this run up finally breaking out over here, you see they went to extreme sell territory, shorting into price gains. They got it right because price managed to come back down, helping them to unwind some of them. And this range-bound movement helped them to unwind a whole lot more. I'm going to zoom into the daily time frame to show you guys what I mean. And you're probably looking at this going, hold on, they're supposed to be heavy sell 72%. So this blue should be down here. On the weekly time frame, we're taking an average sentiment of Monday through Friday. So they're starting this week at 72%. They started last week at 52%. What happened in between that the average is much, much, much less than 72%? Let's zoom into the daily time frame. I'll show you guys what I mean. Now, all this range-bound movement, by the way, really helping them move back. Every time it goes up, able to, the shorts will get in, longs will get out. It then comes back down. You see them move back towards the middle, very close to the middle for quite some time. And then they started slight sell 52%. This is a daily time frame, so each one corresponds to a day. Price went down. And you see them, they actually shifted last week to a slight buy territory. And then afterwards came the big move up, boom, boom. And you saw them shifting back to not just majority short, but to heavy sell territory at 72%. And that's how they got to where they are right now. So what about when it comes to fundamental considerations? Look, over the past few weeks, ever since we got not the PCE out of the US last Friday, but CPE well before that, when we got US CPI figures for the month of June, it really kicked off the story of rotation, right? And that's when everyone said, oh, okay, CPI or US inflation lighter than anticipated. That means the Fed's much likelier to cut rates. That should help some of those other areas that are more sensitive and sensitive to interest rates. And that means that small cap, Russell 2000, the S&P mid cap 400, for example, or even heck, the Dow 30, which doesn't have as heavy a tech weighting as the NASDAQ 100 and the S&P 500 should outperform. They did outperform. They did do quite well, but it was largely confined, the story of rotation, to the US. Now, last week was kind of the first exception. We finally saw gains for the FTSE 100 as well as when it comes to the DAX 40. But that story of rotation was largely confined to the US. Had this happened a few months earlier, I think that you would have probably seen better results when it came to European equities, because the story of rotation at that time, those that were pushing this theory were going rotation. They were talking about getting out of US equities and going into Eurozone equities on anticipation that the ECB is going to cut rates, and some of the data came out a little bit better, but then came political risk, then came data that wasn't so great. Yes, you did get a cut out of the ECB, but it came with other items that with it, and it wasn't really seen as divergence. It was more seen as being a little bit earlier than the Fed. So story of rotation out of tech, largely confined to the US so far. The hopes are, of course, that it gets into other, not other parts of the US stock market, but globally goes into other parts of global equities. And when it comes to the FTSE 100, I should say, I'll start off with earnings from the heavyweights when it comes to the US. That's actually for the FTSE 100 I'm referring to, so for the UK. But we do have earnings from the heavyweights in big tech, Microsoft tomorrow, AMD as well, as a proxy. It's not big tech, but it's as a proxy for NVIDIA, because we're not going to get their figures till late in August. You got Meta or Facebook on Wednesday, you got Amazon and Apple on Thursday. But when it comes to FTSE 100, plenty and with relatively heavy weightings when it comes to FTSE 100. They're going to be releasing their figures this week, and it's mostly low to mid impacting items, with the exception of the big one, and that is just right, Bank of England's monetary policy announcement on Thursday. And the reason why it's so interesting is because market pricing, courtesy of LSEG, is near a coin toss, and at times it has been 50-50. I mean, right in the middle in terms of whether they're going to hold on rates or whether or not they're going to cut. And this is at a time when some central banks prefer to be fashionably early on cutting rates. It wasn't like this before. Before, they were worried about their currency dropping against the dollar. So, because a lot of their imports, priced in US dollars, so they don't want their currency to fall too much against the dollar. Otherwise, it's going to produce inflation. And if that produces inflation, it means they got to raise rates, and they got to backtrack on their rate cuts. So we're noticing now, though, when it comes to a lot of these central banks, is that they are preferring to be fashionably early. Now, I know there's a difference You're saying, okay, well, hold on a second. Like when it comes to the PBOC, People's Bank of China, when they cut their rates and so on, okay, fine. They're not dealing with inflation. They had deflation for a while, and CPI is well below target. Producer price is still in negative territory. You got, for example, the Swiss National Bank cutting. Well, they're cutting with inflation they've had for months on end. It's been CPI below target. The Bank of Canada, for example, inflation is lower and their unemployment rate is higher, so you can't really look at them. Swedish Central Bank, they've got their own issues to sort it. So, okay, each of these guys, the ECB as well for their own reasons. Each of these guys have got their own reasons. You can't automatically put them in the same camp, but we are noticing that with the risks and with all the items coming up as of late, it does feel like when it comes to the rate cut party, fashionably late isn't really where they want to be. They prefer to be, at least from what we're seeing, they prefer to be fashionably early.